Free margin, in its simplest definition, is the money in your trading account that is available for opening new trades. Free margin is calculated using a simple formula. Free margin equals equity minus used margin. Let's look at an example. A trader buys 2 lots of USD at an exchange rate of 1.2000. The transaction value is $240,000. With 1-to-50 leverage, the required margin is $4,800.
After entering the trade, the EURUSD price falls to 1.1905. This movement creates a floating loss on the account.
As equity decreases, your free margin also decreases. In the next video, we'll explain margin level. Stay tuned.
Please like and subscribe.